Welcome back, everyone, to the Market Chronicles. We're hitting episode 12 already, so wow. Thanks to all you listeners out there for sticking with us. You know we love bringing you these deep dives into all the crazy stuff going on in the markets. And hey, if you're watching this on YouTube, don't forget to smash that subscribe button for more insights like this. All right, let's jump in, shall we? Today we are dissecting some really interesting insights from a few market-heavy hitters. They've been discussing the interplay of global liquidity, the US dollar, and how these factors are playing out in asset prices, Bitcoin in particular. We've got some fascinating charts and quotes to unpack here.
Yeah, it is interesting how much emphasis they put on these kind of under-the-radar market forces, right? We're constantly bombarded with headlines about trade wars and the latest economic data. But these experts are saying, hold on a second, there's a bigger picture here. They're really focusing on these fundamental forces that are driving things behind the scenes.
Exactly. It's all about looking beyond the surface level. So let's start with Raoul Pal. He's a well-known macro investor, always has some interesting insights, and his big thesis right now is centered around the US dollar, specifically the need for it to weaken.
Right. He believes that a strong dollar is actually a bit of a headwind for the global economy. It makes U.S. exports more expensive, and it makes it harder for countries with dollar-denominated debt to manage their obligations.
It's like a global squeeze, right? It makes sense, though. A weaker dollar, on the other hand, could act as a kind of stimulus, makes U.S. goods more competitive, eases the pressure on those debtors. Powell is basically saying it's a win-win for the global economy.
And when it comes to the markets, Powell is pretty bullish in the near term. He sees asset prices rising over the next 3 months or so. He expects some consolidation periods down the line, which is natural, but his overall outlook for the next year remains positive.
Okay, so what's driving his optimism? He keeps hammering on this one key factor.
Liquidity, my friend. Good old-fashioned liquidity. He believes it's the primary force behind market movements. He even says it's leading the market by about 3 months.
And he's got a chart to back this up, right? This one from Global Macro Investor that compares global M2 money supply, which is a measure of all the money sloshing around out there, against Bitcoin's price.
Yeah, it's fascinating. This chart, according to Powell, shows Bitcoin approaching a bottom. He points to these historical patterns where Bitcoin tends to find its low point about 10 to 12 weeks after a dip in global M2 growth.
So it's like this leading indicator. As money supply starts to recover, Bitcoin follows suit a bit later. Interesting stuff.
It is. But of course, you always have to be cautious with correlations, right? They don't always imply causation. But the pattern Powell highlights here is definitely something to keep an eye on.
Absolutely. Now, Powell does acknowledge the market's reaction, stuff like Trump's latest tariff threats, those headlines that everyone freaks out about. But he thinks a lot of that market movement, especially the recent downturn, was already baked in. He attributes this to the dollar's strength earlier in the year and the rising interest rates we saw.
Makes sense. When interest rates go up and the dollar strengthens, it creates tighter financial conditions, which tends to put downward pressure on asset prices. He's basically saying that the market was already adjusting to that reality, so these tariff headlines just added fuel to the fire.
Right, it's like the market was primed for a pullback. But here's where things get really interesting. Powell sees a shift happening. He says financial conditions are easing rapidly.
Really?
Yeah, he points to forward-looking global M2 data, the Financial Conditions Index. He even says they are screaming higher.
Okay, so what does this mean for the average investor? Break it down.
Essentially, it means money is becoming more available. Think of it like this. Borrowing costs are coming down, and investors have more cash to deploy. It's generally a good sign for risk assets.
Interesting. So financial conditions are easing, but what about the actual economic data? Is it reflecting this shift yet?
That's the thing. It's lagging a bit, but Powell expects the Economic Surprises Index to catch up soon and start showing more positive data points. He sees this improvement in financial conditions as a precursor to better economic performance down the line.
Got it. So the foundation is being laid, but we're not quite seeing the full effects yet. Makes sense. Now, what about Bitcoin specifically? How does this all tie in with Powell's outlook on crypto?
Well, he makes a really interesting observation there. He points out that Bitcoin's 3-month price change has already factored in the previous period of tighter financial conditions. So he's saying Bitcoin has already weathered that storm. Now he expects its price to start reflecting this current easing, which could mean a more pronounced upward move.
So his thesis is that Bitcoin, being this global digital asset, is already sensitive to these shifts in global liquidity. It's like it's anticipating the broader economic effects before they become fully apparent in traditional data.
Exactly. And to drive this point home, Pal references a conversation he had back in September of last year. Remember, that was a time of peak pessimism in the market. People were doom and gloom.
Right. There were a lot of concerns about a global recession. Inflation was still raging. It was a pretty bleak outlook.
Yeah, and Pal uses that as a stark contrast to the current situation. He's basically saying, look, sentiment was terrible back then, but my analysis of liquidity suggests things are actually looking much better now.
Okay, I'm getting a much clearer picture of Powell's perspective. So we've got this easing of financial conditions, a potential bottoming out in Bitcoin based on that global M2 chart. It's shaping up to be a pretty interesting next few months, to say the least.
For sure. Now, let's bring in the perspective of another expert who's been closely following these developments. And they agree with Powell on a lot of these points. They also see financial conditions improving, particularly since February, mid-March timeframe. And they're also bullish on Bitcoin for the medium term, like over the next 3 to 12 months.
It's reassuring, isn't it, to have multiple experts potentially looking at the same data through different lenses, coming to similar conclusions, gives you more confidence that there's something substantial here.
It definitely adds weight to the argument. However, the second expert throws in a bit of a curveball.
Oh, tell me more.
They bring up this new tariff formula that's recently been implemented. They say it's caught a lot of people off guard, and it could force the Federal Reserve's hand.
Okay, so how does this impact the outlook?
Well, historically, when the Fed has intervened in situations like this, it's often been bullish for risk assets. So this new tariff situation could actually end up being a catalyst for the market, especially for things like Bitcoin.
So we've got this backdrop of easing financial conditions, which is positive on its own. But now we have this additional layer of potential stimulus coming from the Fed, driven by these tariffs. Things are getting interesting. Now, this expert also provides a really useful definition of financial conditions, because it's a term that gets thrown around a lot.
Yeah, sometimes it can feel a bit abstract, right?
Exactly. But they break it down really well. They explain it as this combination of interest rates, the strength of the dollar, and the prices of commodities and other inputs.
So it's not just about one indicator, it's about the overall picture. And they point out some recent significant moves in all these areas. Oil prices, interest rates. They even mentioned a head and shoulders top forming in the rates market, which often suggests lower rates ahead.
And let's not forget the U.S. dollar. That plays a huge role in the overall picture of financial conditions, right?
Oh, absolutely. This expert calls it the big daddy of all liquidity measures. They explain it this way. So much of global debt is denominated in U.S. dollars, so the dollar's movements have this ripple effect throughout the entire world.
Right. We touched on that earlier with Powell's point about how a weaker dollar can help countries manage their dollar-denominated debt. It also boosts their exports.
Exactly. And just to reiterate, both experts agree on this core principle. A weaker dollar is good for global trade. It makes U.S. goods more competitive, which helps the U.S. economy too. They both see it as a form of global stimulus.
Okay, so we've got a clear consensus on the dollar. Weaker is better. But let's get specific about Bitcoin. The second expert does a deep dive on the relationship between the U.S. dollar and Bitcoin, specifically looking at the DXY, which is the U.S. dollar index.
Right, and they point out this historical inverse correlation between the two. Makes sense. When the dollar weakens, dollar-denominated assets like Bitcoin tend to become more attractive.
Yep, classic supply and demand dynamics at play.
Now, here's where it gets really fascinating. This expert looked at instances where the DXY had these sharp, multi-day drops, specifically a 3-day consecutive decline of more than 2.5%. They say these are statistically rare events.
Okay, so what did they find?
Get this. Over the past 12 years, this kind of drop in the DXY has only happened 8 times, and on every single occasion, Bitcoin was significantly higher 90 days later.
Wow, that's a perfect historical record, even though the sample size is fairly small. But still, a perfect record over 12 years, that's hard to ignore.
Right, and they even provide a chart showing these historical instances and the average performance of Bitcoin after each of these dollar dips. On average, Bitcoin was up a whopping 37% 90 days later. And if you look at the one standard deviation move, it suggests potential gains as high as 63%.
Wow, that's massive. So if history is any guide, a sharp drop in the dollar could be a very bullish signal for Bitcoin. I mean, if we apply those historical returns to today's prices, you're looking at potential price targets somewhere between $110,000 to $115,000 for Bitcoin.
Exactly, and possibly even higher if we see a move at the upper end of that historical range.
So should investors be piling into Bitcoin right now?
Well, Not so fast. This expert points out that, interestingly, the current performance of Bitcoin after the most recent DXY drop is actually the weakest out of all 8 historical signals.
That's a bit of a head scratcher. Any explanations for that?
They offer a few potential reasons. One is that even though Bitcoin is lagging this time around, it's still in line with how it reacted in 2020 and 2015 after similar dollar dips. So it's not completely out of the ordinary.
Okay, so this time might just be a bit slower.
Potentially. They also point to tax loss selling in the US as a factor that might be dampening the immediate response. It's tax season, and a lot of people who bought crypto last year might be selling now to offset their capital gains. Ah, right. That could definitely create some short-term downward pressure. So, taking a step back and looking at all this, what are the key takeaways for our listeners?
The biggest takeaway, I think, is this. These experts are seeing a real shift in market conditions. They point to easing financial conditions, a weaker dollar. They're painting a pretty optimistic picture, despite some near-term uncertainties, like these new tariffs and the tax-related selling pressure.
And that historical data linking a weak dollar to strong Bitcoin performance, that's pretty compelling. It really suggests that Bitcoin could be in for a significant rally if the dollar continues to weaken.
Right. And this leads to a really interesting question for everyone listening. If this connection between dollar weakness and Bitcoin holds true, what other assets out there might benefit from a sustained period of dollar depreciation? What kind of ripple effects could we see throughout the financial system?
It's definitely something to ponder. The global economy is this complex web of interconnected systems, and when a major piece like the US dollar shifts, it can have these far-reaching consequences that we might not even fully grasp yet. So it's worth paying close attention to how these macroeconomic trends unfold. It's all about connecting the dots.
Couldn't have said it better myself. Always a pleasure diving into these market mysteries with you.
Likewise, always learning something new.
And to all our listeners out there, thanks for joining us for this deep dive into the Market Chronicles. We'll be back next time with more insights. Until then, happy investing.